Hey everyone, and welcome back to the channel. In today's video, of course, as you can see, we're doing stock market Q&A for the month of April 2020. And as you can see from the title, one of the questions that I got was in regards to the performance of my portfolio this year so far. So we are going to be talking about that a little bit later in the video, so stay tuned. But we've got a ton of questions here to get through. Well, I say a ton, we've got about 6 or 7 questions, which is about the most I can get through in these videos, unfortunately. But thanks to everyone who submitted a question. It's very much appreciated that you make my life easy by just submitting tons and tons of questions, and I do apologize for not being able to answer all of them in this video. But if you're curious about how you can get a question in these monthly videos, then first thing you need to do is you need to be subscribed, and then basically every single month I make a post on the community board of my channel, and you can just comment your question on that post, and if you are subscribed, that post will appear in your subscription box. So if you don't want to miss the post, because usually I make the post and then within the first day I take a few questions from there, so you have to be pretty quick in order to get a question in this video. But be subscribed, you'll see it pop up in your subscription box in about 4 weeks time, and then yeah, you can hope that I select your question. And again, I apologize for the ones that I can't get to, but we've got some very interesting questions this week, so let's get straight into it. And the first question we had here was, can you talk about investing in hyperinflation environment, which was predicted by Ray Dalio? Yeah, so if you haven't seen Ray Dalio's full comments on this, I highly recommend you go check his explanation out, because his explanation is much more thorough and he understands this topic a lot better than I do. So I encourage you to check that out. And he recently released a TED talk as well, discussing the current market impacts and what he thinks is going to happen in the future over the next few years. So I recommend you go check that out. But more or less, what is happening at the moment? So at the moment, first of all, interest rates have hit 0 in the United States, and they're basically there in Australia as well. So what does that mean? Well, it basically means that the Federal Reserve in the US, or the Reserve Bank in Australia, cannot lower interest rates anymore in order to kickstart the economy. So they need to do something else, or something else needs to happen in order for the economy to be kickstarted. And that thing that needs to happen is that the government spends money and puts it into the economy. They give it to businesses, they give it to individuals in order to kickstart the economy that way. And that is basically what has been happening over the past few months. So I think the US government put in about $2 trillion into the US, and the Australian government put a few $100 billion into our economy as well. And basically what that does is they have to get that money from somewhere, so they borrow it. And how they borrow it is they create government bonds. So they issue these government bonds, someone else buys them, and as a result, they get money that they can then spend in the economy and kickstart the economy. So what happens when they issue more bonds? Well, there's more supply of bonds, which means that interest rates go up. And generally, when economic conditions aren't good, the Federal Reserve will want to keep interest rates low. So in order to keep interest rates low, they will print money and buy those bonds in order to add some demand to the side of in the bond market in order to balance out that supply and keep interest rates low. So that is the long and technical way of explaining it. But if you want the shortcut way of explaining it, more or less what has happened when this process happens is the Federal Reserve prints money, gives it to the government, and the government spends money in the economy. And that spending creates inflation. It creates products and services get more expensive overall. And that means that because there's more money in the economy, the value of the dollar goes down. The currency is devalued, I think is probably the correct way to explain that. So what happens next? Well, there's a couple of things that happen. One is that the currency that you have, the cash that you have, will become less valuable. It will be able to purchase less products and services because they have gotten more expensive. But there's also something else that happens to the stocks that you own, and that is that for the most part, stocks generally are considered inflation protected, because when products and services get more expensive, when people are paying more for products and services, those businesses will generate more revenue. They will be collecting more money from people. So even though the currency is devalued, it's less valuable, people are willing to spend more of their currency on products and services. Products and services are more expensive, and as a result, businesses are collecting more money. So what do I think about this, and how does this impact my behavior? Well, this sort of effect of inflation that occurs across time in all circumstances, but it will be higher in other periods where there's a lot of money printing and that sort of thing. Holding businesses, holding equities is the smart thing to do, because they are, generally speaking, inflation protected. So if you're invested in businesses, the value of those will go up, while the value of your currency will probably be, well, I mean, in dollar terms, it's not going anywhere, but in real terms, in inflation terms, it will be devalued slowly over time. So you don't want to hold on to cash for too long, but there are periods where it makes sense to hold cash. There are short periods where it makes sense to hold cash, and those are periods where stocks are really expensive and you can wait for opportunities, which is what I've been doing for the past couple of years. But I don't want to be holding on to cash. I won't want to be holding on to cash for too much longer. It's something that you don't want to keep too much cash around for too long, because then you are certainly going to lose out to inflation. It's better to have a bit of cash around when you think things are expensive, and then when the opportunity presents itself, invest in businesses, be mostly exposed to stocks and other types of asset classes that are inflation protected, and then over the long term, they will do very well. The next question that we've got here is, how do you stand on your investment in Thor Industries in times like these? Greetings from a Thor shareholder out of Germany. Greetings. Yeah, so I mean, I certainly still think it's a great company. That hasn't changed, and generally when I find a company that I think is great, that's probably not, in most circumstances, that's not going to change unless something dramatic changes within the business. So what has happened with Thor? I mean, Thor took on quite a lot of debt, quite a lot more than I would be comfortable with in most circumstances. So that's something I wasn't super happy about, but I trust the management's history in making good acquisitions and using debt to do so, and then paying down that debt. So I still think it's a great company, and as the stock price has been falling, I've been investing more. So over the past few weeks, I've been continuing to invest in the company when the opportunity presents itself to do so at an appropriate price. The next question we've got here is, do you hold any physical precious metals? No, I don't. And I know that a lot of people do, and maybe this is something I will do at some point in the future. But for now, considering that precious metals don't generate me cash flow, it's very difficult for me to figure out what I'm going to get out of them in the future. With a precious metal, maybe there are other ways that I'm not aware of, and if there's some kind of way that you can figure out what you're going to get out of a precious metal, then I'm curious to hear it down in the comment section. But generally speaking, I'm looking for assets that can cash flow so that I can estimate those future cash flows and therefore figure out what price I want to pay. And at the moment, that is for the most part at me looking into businesses that are on the stock market. The next question that we've got here is, how did you manage your Texas Roadhouse investment during the crash, and what are your thoughts on it moving forward? Yeah, so Texas Roadhouse is one of those businesses that I own that basically has no debt. I love the management team. I think it's clearly got some distinct advantages in terms of its branding, and that presents itself in more customers coming back to restaurants consistently and at quite a high rate compared to other businesses in the industry. So I clearly think it's a great business. It was just a matter of its price. So last year I made two very small investments last year. That was it. And one of those investments was in Texas Roadhouse at around, I think, $50 per share. And really the reason why I didn't invest more at the time is because its price was too expensive. And that changed over the past few weeks. So over the past few weeks, I have invested more. I would like to see it go down further, but I did get a decent position into Texas Roadhouse in the past few weeks. But I mean, as you've seen, I'm still holding quite a bit of cash. So clearly I'm looking for either those businesses that I already hold to get even cheaper, or for some other business that I'm not invested in to become cheap so that I can add a new business to my portfolio. The next question that we've got here is, you said that you went from 60% cash to 30% during this quick crash. How did you decide how much and what stocks to buy among the ones that were on your wish list that reached the price that you wanted? Why did you spend around 30% of your cash position instead of more or less? Yeah, so generally speaking, when I'm investing in great companies, I have a range at which I think I have a buy range, a range in which I think that I can get a 15% or more return with a margin of safety. And that range might be, I mean, for Texas Roadhouse, just to piggyback off the last question, that range has been somewhere between $20 and $40 per share. So generally speaking, I'm starting to invest a little bit at the top end of that range. And then as it gets closer to the bottom, I'm really going quite heavy into investing in that business. And I can use Texas Roadhouse as an example to explain exactly what I did with that business and what I've done so far. Of course, this might change in the future, so this isn't me telling you to go out and buy Texas Roadhouse at all, because things might change since this video gets posted and I might no longer be in the position or something like that. So, but basically I had the range of about $20 to $40, and last year I found that I had too much cash laying around. I had 65 or 70% cash, and it was just too much. I wasn't comfortable having that much on the sideline. So I was willing to accept a lower return in a business that I thought was really great. So I made a really small investment into Texas Roadhouse at about $55 per share, which was kind of just outside my range. And then I didn't invest anymore. Come around to this year, its stock fell quite dramatically, and it fell to about $25 per share, so quite near the bottom of my range. Now, I didn't pick it up at $25 per share. I picked it up at about $30 per share. But the investment that I made at $30 per share was about 3 times the size of the one that I made last year. So you can see that my investing in a business gets heavier as it gets closer to the bottom. And if Texas Roadhouse was to fall to $20 or $18 per share, for example, you should expect that I would be putting quite a substantial amount more into that company to build that up to quite a big position in my portfolio. As long as nothing has intrinsically changed that makes me think it's no longer a great business, or something has changed that impacts the amount of cash I think I can get out of that business in the future. And the final question that we had for today is the one that I'm sure a lot of you guys are waiting for, but this question from Ben is, how is your own portfolio going? So before I answer this question, you guys all know that I don't really I'm not patting myself on the back for the past few months when I'm showing you these results, because I know that in the short term, anything can happen, and after this video goes out, the stocks in my portfolio could perform terribly against the index, and 1 month later or 2 months later, I could be underperforming the index. So I like to look at my returns over 1 year at the minimum, which is why at the end of each year, I make a video going through my portfolio performance for transparency. But even 1 year really doesn't tell you much about how my investments are going. Really, you need to look at them over multi-years in order to get any kind of idea as to whether they have been good investments. But in terms of my portfolio, for those who are curious, year to date, my portfolio is up about 4.4%. So that's from January 1 until now. My portfolio is up about 4.4%, and that is including capital gains, so the stock prices of those businesses going up, dividends, and currency gains. So if the US dollar has exchanged with the Australian dollar, that's also included in that number. And if you're to compare that number to the US market and the Australian market, it actually looks pretty good, because the US market year to date is down 14%, so negative 14%, and the Australian market is down 20%. So to be positive anything, considering the last few months, is fairly good, although, as I said, it's in the short term. It means absolutely nothing to me. And in fact, I would have almost preferred if my portfolio underperformed the market, because that would have meant that the businesses in my portfolio would have performed really poorly in the short term, and I would have had more of an opportunity to deploy even more capital into businesses. But it is what it is. And those numbers that I'm showing you, 4.4%, that doesn't include my cash position. So that's just looking at the 65% that is invested in, or the approximately 65% that's invested in the stock market. So I haven't run the calculations to include cash or anything like that yet. So that is what you would expect in the video that I post towards the end of the year when I round out my year. I wasn't even planning on talking about my results up until now, but someone asked the question and I thought, why not? I'll just share it with you guys. But I hope you guys enjoyed this video and got some value out of the questions that I answered. And as I said, if you want to ask a question and have a chance for it to be in next month's video, in May's video, then make sure you're subscribed. If you want to see more content, of course, hit subscribe as well. It's the best way. But make sure you're subscribed so that you will see the post appear in the subscription box on the community board, on my community board in the subscription box in a month time when I make that post, so that you can ask your question. But I'm also curious to hear your thoughts about how your portfolios are going, and any other questions that you might have down in the comment section. Usually I'm answering questions straight after a video goes live, so if you have any, feel free to go down there. But other than that, thanks everyone for tuning in, and I'll see you guys next week.